Citizens Property Insurance just cut rates 8.7%, and 12 Florida cities are still turning into ghost towns in the 2026 housing crash. For 3 straight years, every housing channel sold you the same story. Florida was dying because of insurance. Premiums doubled, then tripled. People fled, and the market cracked under the weight of it. Here's the problem with that story. Insurance got cheaper. The market cracked anyway. The writing is on the wall, and it says something the doom crowd never accounted for. Florida Insurance Commissioner Michael Jaworski approved an average 8.7% statewide rate decrease for Citizens Property Insurance, the first cut since 2015 and the largest in the company's 24-year history. 73 private carriers filed decreases. State Farm filed for 10%. Citizens has shrunk from 1.42 million policies in October 2023 to roughly 395,000 by January 2026 because private carriers are taking those policies back. That's not a collapsing insurance market. That's a recovering one. And home values in these 12 cities kept falling through it. Now, the comparison you've heard 100 times is 2008. That's wrong. And here are the numbers. At the peak in 2009, 23% to 24% of all American mortgages were underwater. Today, it's under 2%. Foreclosure starts are down roughly 82% from 2008. Adjustable rate mortgages were 35% of new originations in 2006 and are 7 to 8% now. Intercontinental exchange mortgage technology puts national delinquency at 3.55%, below the 4.16% it recorded in June 2019. So this isn't 2008, and that should worry you more, not less. In 2008, the damage was systemic, which made it everyone's problem, which produced a national response. Florida in 2026 is localized, concentrated in specific counties, price tiers, and purchase years. Nobody bails out a market that's only broken in 12 places. The loss stops with whomever holds the deed. So if it was never the premium, what's draining these markets? One number explains it, and it's not a housing number at all. I'll show you in about 90 seconds. Second, one city on this list holds the worst foreclosure rate of any metro area in the United States. Not the worst in Florida, the worst in America. It's not the one you think. Third, and this is the one that matters most to you personally, hundreds of thousands of Florida homeowners physically cannot sell right now, even if they want to. Whether you're one of them comes down to a single year printed on your closing documents. One more thing before the countdown, because this is where other channels lie. These places are not literally emptying out. Florida still added 196,980 residents in 2025. What's going dark is the transaction. Listings that sit 80 days. Sellers who pull the sign out of the yard rather than take the offer. Buildings where nothing is closed in months. That's a ghost town in 2026, and it costs you more than an empty house would. Number 12, the Villages and Wildwood. List prices there are up 1.4% over the last 12 months. Sounds fine, except closed prices in the Wildwood Metro fell 4% in the first quarter of 2026, and Zillow forecasts another 1.5% down, another $5,624 by June 2027. Realtor.com counts Wildwood among the 9 Florida metros where homeowners lost 5 figures in a single year. The Villages is the retiree engine of the state, the purest read on retired demand in America. When what sellers ask goes up and what buyers pay goes down, that's not strength. That's sellers who have not accepted the new number. Every other market on this list went through that phase first. Number 11, Deltona and Daytona Beach. Median list price fell 3.6%, a drop of $14,100 to $379,900, with another 1% forecast by June 2027. Statewide, the median Florida homeowner lost $10,157 between January 2025 and January 2026. Of 29 Florida metros, Realtor.com measured exactly 4 gained value, and the largest gain in the state was $2,427 in Lake City. 4 metros made money last year, and the best made $2,497. That's not a correction concentrated in beach towns. It's the entire state's housing wealth going sideways at once. And Deltona is the average case, not the outlier. Number 10, Palm Bay and Melbourne. Almost identical damage, down 3.6%, a loss of $14,000, now at $375,000, with another 1.1% forecast by June 2027. Palm Bay matters for a different reason. The standard explanation for Florida weakness is that these are speculative retirement markets with no employment base. Palm Bay is the Space Coast. Aerospace, defense contracts, real payroll. It has the job base that theory says should protect it. It's falling anyway. When the jobs argument stops working, the cause is upstream of jobs. Number 9, Port St. Lucie. Another metro on that 5-figure loss list, and where the second crisis surfaces. As of January 1st, 2026, under Section 718.112 of Florida Statutes, condo associations can no longer waive reserve funding. On August 1st, 2026, the Florida Legislature's Watchdog Office reported more than 2,500 buildings flagged for deeper structural review. Statewide condo values are down 9.9%. The financing consequence is what moves prices. Assessments in flagged buildings run from $10,000 to well over $100,000 per unit, and more than 1,400 Florida condo buildings now sit on Fannie Mae's unavailable list, meaning conventional financing is off the table. A unit nobody can get a mortgage on is not worth what the last comparable sale says. It's worth whatever the nearest cash buyer offers. And cash buyers know exactly how much leverage that gives them. Number 8, Ocala. ATTOM Data Solutions puts Ocala's foreclosure rate at 0.31% of housing units in the first half of 2026, top 10 in the country. And Ocala posted the single largest collapse in home seller profit margins of any market in the U.S. in the third quarter of 2025. Not top 5, first. That number doesn't measure what homes sell for. It measures what sellers walk away with after they bought, held, and sold. Ocala led the nation in that collapse, which tells you the people getting hurt are not investors watching a spreadsheet. They're owners who held and got a smaller check than the math promised. Number 7, Point Siena and Osceola County. ATTOM ranks Osceola among the top 4 Florida counties for foreclosure filings. And Florida records the highest average annual foreclosure filings per zip code in the nation at 4,871. Nationally, foreclosure filings rose 21% in the first half of 2026, while the average time to complete one fell to 563 days, the shortest since 2013. More filings and faster resolution means distressed inventory hits the market quicker than it has in a decade. In a market with buyers, that gets absorbed. In Osceola County, it becomes the comparable sale that reprices your neighbors. If you own property in Florida or you're thinking about buying here, hit the like button right now. It helps this channel reach people making a $400,000 decision with bad information. Let's keep going because the next 6 get worse. Number 6, Naples and Marco Island. The luxury tier is supposed to be immune, but it's not. Median list prices fell 6.6% in 12 months, a drop of $49,100 from $749,000 to $699,900. Zillow's Home Value Index has Naples down 4.4% year over year, with another 1.4% forecast by June 2027. Naples is the cash buyer market. No mortgage, no rate sensitivity. The whole argument for why high-end Florida holds up is that its buyers don't need loans. That assumes the cash buyers show up. Nearly $50,000 came off the median list price in a market where financing was never the constraint, which tells you the constraint was always the buyer. Number 5, Lehigh Acres. The market sold hardest to out-of-state investors during the boom. Redfin puts it down 6.1% year over year to a median of $310,000, with homes taking 74 days to sell against 67 a year ago. At the zip level, it's uglier. Zillow has 33974 down 8.8% and 33973 down 8.3%. Those are not vacation condos. They're working family neighborhoods at exactly the price point where FHA borrowers with 3.5% down were buying in 2022 and 23. A low down payment against a falling zip code is the fastest route to negative equity in the state, and Lehigh Acres has it in volume. Number 4. Northport, Sarasota, and Bradenton. Down 5.3% year over year, but the peak number is what matters. ResiClub's analysis of Zillow data shows Northport values down 17.4% from their July 2022 high. Over that same stretch, national home prices rose 1.9%. Zillow forecasts another 2.8% down, a further $13,580 by June 2027. Sit with that gap. A buyer in Northport and a buyer in Ohio purchased the same month. Both made every payment, and 4 years later, one is down 17.4% and the other is up. Same country, same rates. Location did all of it. National headlines are useless for a decision about a specific address. Number 3. Lakeland and Winter Haven. Here it stops being about price and starts being about people losing their homes. ATTOM's mid-year 2026 report puts the Lakeland and Winter Haven foreclosure rate at 0.48% of all housing units, 1 in every 421 homes, second worst of any metro area in the United States. Median list price down 2.7%. Winter Haven sits inside that metro, and Winter Haven is the market named in every Florida collapse video on this platform. The ATTOM number is real. Almost everything else you've been told about it is not. If a channel gave you a vacancy rate or a triple-digit foreclosure increase for that city, ask where it came from, because it's not in ATTOM, Zillow, Redfin, or Realtor.com. Number 2. Cape Coral and Fort Myers. Zillow's Home Value Index has Cape Coral at $337,346, down 6% year over year, roughly $21,500 gone in 12 months. Foreclosure rate at 0.35%, top 10 nationally. And this is where the third thing I promised comes due. Intercontinental Exchange Mortgage Technology reported that in Cape Coral, where prices are down about 15% from peak, 11% of all mortgages are underwater, including more than 1/3 of every loan originated in 2023 and 24. Make that concrete. You bought at $400,000 in 2023, FHA 3.5% down. Your loan was $386,000. 2 years of payments at 6.75% leaves a balance around $377,486. Your house is now worth roughly $340,000. You are $37,486 underwater. You can't sell without writing a check you don't have. You can't refinance. You are not a homeowner anymore. You're a tenant who pays the property taxes. Number 1. Punta Gorda and Port Charlotte. ATTOM Data Solutions ranked Punta Gorda the worst foreclosure market of any metro area in the United States in the first half of 2026. At 0.5% of housing units, 1 in every 200 homes. Zillow has it at $335,672, down 8.3% year over year, about $30,383 erased in 12 months. From the July 2022 peak, ResiClub puts Punta Gorda down 25.3%. Zillow forecasts another 3.7% lower, another $14,060 by June 2027. Realtor.com recorded the median Punta Gorda homeowner losing $26,624 in a single year. The supply picture explains why the forecast keeps pointing down. Active inventory runs 114% above its historical norm, one of the largest overhangs in the country, and Charlotte County values are down 9.6% year over year. Moody's had Punta Gorda overvalued by 57.8% in 2022. After everything you just heard, their model still shows it overvalued by 9%. The correction has taken a quarter of the market's value, and the model says it's not finished. So here's the number I promised, the one that's not a housing number. In 2022, 310,892 Americans moved to Florida from another state. In 2025, that figure was 22,517, a 92.8% collapse, straight from the Census Bureau's vintage 2025 estimates released this January. Florida, at or near the top of domestic migration for a generation, finished 8th. Alabama took in more Americans than Florida did. That's the whole story. Florida didn't build too many houses. Florida built exactly enough for 310,892 arrivals a year, and then 288,000 of them stopped coming. Insurance relief doesn't fix that. Rate cuts do not fix that. You cannot discount your way out of a missing buyer. The builders already know. Lennar's average sales price fell to $371,000 in the second quarter of 2026, down from a cycle high of $491,000 in the third quarter of 2022. A 24.4% decline, with 12.9% of every sale price going out as incentives. Stuart Miller called the market erratic on the June 12th earnings call. D.R. Horton is closing at roughly $362,000. When the two largest builders in America hand back a quarter of their pricing, that sends shockwaves through Wall Street long before it reaches your county assessor. So what do you actually do with this? If you own in these markets and bought before 2021, sit still. You have equity and almost certainly a mortgage in the 3s. Selling into this to rebuy at 6.5% costs you twice. Your paper value is down and your position is fine. Those are two different things. If you bought between 2022 and 2025 with a low down payment, pull two numbers this week. Your principal balance from your servicer and a real valuation from recent closed sales on your street, not a Zestimate. The gap determines every option you have for 3 years. If you're under, your job is not to sell. It's to stay current and let amortization work, because time is the only thing that fixes negative equity. If you hold Florida rentals, run the real carrying cost. Insurance may be falling, but taxes, assessments, and vacancy are not. If it does not cash flow at today's rent, it is a bet on appreciation in markets Zillow forecasts to keep declining. And if you're buying, 22 of Florida's 29 metros are forecast to lose value over the next 12 months. That is not a reason to run. That is a reason to negotiate like you mean it. Get 3 insurance quotes before you write the offer, not after. Read the reserve study and the last 12 months of board minutes on any condo and confirm the building is not on Fannie Mae's unavailable list. Ask what the seller paid and when, because a 2022 buyer has room to move and a 2015 buyer doesn't. One last signal, because it tells you when this turns. Redfin reports 5.8% of all United States listings were pulled off the market in April 2026, the highest since March 2020. And Florida leads the country in delistings. Every seller who withdraws rather than cuts comes back next spring. Until that backlog clears at prices buyers will pay, the floor under these 12 markets is people refusing to sell. That's not a floor, that's a delay. Subscribe and hit the notification bell so the next video lands in your feed the moment it drops. And watch this one next.